be here. Let's just jump right into it.
So I thought I was supposed to keep it.
You know, the question I am most, I mean, the panel,
If you need it, you
panel
can have
topic
it.
is, what's going to happen when the
You got
music
it,
stops? Not if, but when. And without a doubt, it's the question I am most often asked is, you know, when is the correction going to happen? How bad is it going to be? You know, who's it going to impact? What's going to happen? Is it time to dust off my Good Times, RIP Good Times tombstone and bring it out? What says the panel? What's going to happen? Are we headed for a bad correction?
So,
who wants to jump in? Rebecca.
do you want me to start?
Go
So
for it.
I've had the opportunity to live through two times in my past where the music stopped. Once at a startup that gone public called NextCard, and then another time in '08 when I just entered venture. And I think the one thing, I mean, there's a lot of other things that happen in terms of valuations and all that, but the one thing that happens and that we notice, you know, both inside a company and from the venture perspective, is that as the market's going up, all sins are forgiven, right? People can overlook a lot of stuff as long as there's one good, strong, positive metric, if it's revenue or growth or whatever. Little things like churn and things like that can be forgiven. When the music stops, like, all sins are uncovered. And so I think, again, to John's point, the operational excellence is what then matters more than anything else. And so those are the companies that really will make it through on the other side.
Could everyone hear her? Fine? Yes? Okay. Are we headed for a correction? Jenny, it looked like you wanted to say something.
No, I actually don't. I
Okay.
No predictions, and
I can't hear
I
you.
have really no idea.
Your
Yeah.
mic isn't on. Your tone?
Yeah, it sounded like your mic wasn't on. I could walk around and.
Yeah,
I actually have no idea, but I can give you some data points. Actually, when the bullpen guys asked me to be on this panel, I said, but I'm a pre-seed investor. I think I'm the only one. And if the music stops, I guess I'm out of a job. So, so obviously, I'm pretty excited about early stage investing, and I think it's going to continue for a long time. I mean, there's only two things I know, and that's incredible entrepreneurs are going to keep on building companies, and really great smart money is going to keep on investing in it. And I think you'll see a lot of the tourist VCs and all of those guys maybe heading out, but I think there's still a lot of money around, so I'm not super worried. But my data point is that I run accelerator programs, and I ran one earlier this year. So these are early stage companies. We're the first money in. 2 of those companies that went through my program of 10 have raised $10 million in the last month, which is kind of shocking. And 2 of them have raised between 5 and 7. So I think those numbers are large, and I think what we're telling our companies is take all the money that you can get right now.
Good advice. Is your mic working? Is it on? No, I can't hear you. Do I have to walk around? Okay. Go ahead and speak.
We can pass it.
I actually think that the sort of pre-seed, seed investors and early stage companies might even welcome a little bit of a correction. I think what we found is that a lot of the seed investors, the traditional sort of super angels, micro VCs, have kind of gone a little bit quieter in the last 12 months in terms of leading rounds. It's a lot of pro rata maintenance, a lot of sort of smaller participation. Because they can't do the 1.5 on 6 pre-deal that they used to do. So I'd actually expect a lot more activity from super angels, from micro VCs, and then on the company side, could be a good thing too, because hiring is horrible. And if we can have a little bit of correction and larger companies can sort of make indiscriminate chops of their workforce, I think you could actually have a lot of great talent that's available.
Is this working? Is this thing on?
Yes, yours is on.
Satya, yours works.
Yours is on.
I mean, I think the music won't stop, but the volume will get turned down. And then fundamentally what it believes is that we're moving from a period of time where you didn't have to show and you could tell to one where you have to show as well as tell. And that what that means is that as the liquidity market continues to be constrained, this is, I think, the lowest year for IPOs in terms of dollars raised in quite a long time in tech. The M&A market is pretty tight. That means that the later stage investors are sitting on a bunch of expensive and in many cases overvalued assets. So they're going to be even more diligent around financing or investing in companies that are not kind of performing. And so what you're going to see is that while market has already been tight around Series A and Series B financing, despite the big financings you hear about. It's going to get even tighter. So if you're a seed stage or Series A company, it means that you have to get back focused on business fundamentals and showing, not telling.
Mm-hmm. Good advice. Get focused on the business fundamentals. Micah, you're sitting in for Paige. You're with Amazon Web Services. Yes or no? Are we headed for a bad direction?
Yeah, I mean, I have no idea. Is my mic on?
No.
Luckily, I'm loud. Yeah, I mean, I look at it sort of in two directions. Is the fact that for a while there was a lot of bets being taken. So investors were much more comfortable taking bets on things that were flyers and sort of allowing the Series A guys or Series B guys to figure out whether there was an actual business there. And I think for most founders, the importance now is making sure that you have the ability to extend your own runway, right? So the extra spending, the should we get expensive chairs, all the things, the same conversations that occurred in 2000, 2008 are occurring now. How do we shrink that down? And the nice thing is most infrastructure at this point is relatively cheap. Building an actual company is relatively cheap. So the ability to adjust that becomes much more simple now. I do think that for the founders in the room, the important takeaways here are really the words show, don't tell. At the end of the day, the companies that are able to show that they're actually on a path towards profitability, there'll be no problem. There will be music playing for them. The companies that won't find the next step will be the ones that are meandering and sort of trying to figure it out as they go. And I think that those bets that you're able to take and guesses you're able to take, you're not going to get 3 or 4 shots at it. You're going to get 1 to 2.
I liked what Jenny said a moment ago about, I'm paraphrasing, but you said, good times and bad, money is still being invested by the VCs and others. But in a correction, so when the music stops, what's going to happen? How are the entrepreneurs in the audience going to be impacted? Well, how's everyone going to be impacted, really? When the music stops, what's going to happen with people? What's that?
What's going to happen?
Yes.
When the music stops.
It sounds like your mic's working.
Is mine working?
Yes.
Oh wow, magic. No, I mean when the music stops and what you start to see is you start to see down rounds oftentimes, especially in those later stages. You start, it's just harder, so only the best of the best companies will get funded. So right now, we'll see a company, we like it, we like the team, we like the space, and we'll see 6 more just like it that week. That stops very quickly. And so it's actually a good opportunity for people. And it's sometimes because there's not competition. People will fund 1, not 6, right? So it's actually, if you go back and if you kind of go back and map when those biggest companies were actually built, the Googles and the Facebooks and the lending clubs and the like, and Amazons, and they actually often started in a downturn. And it largely is because you can kind of get on the playing field and get some runway in front of you before there's 6 more that look just like you coming up at your heels. So I actually think for both venture and for startup companies, downturns are not a bad thing. If you're already if you're already operating when it happens, you have some momentum behind you, and you have to be very smart. You have to be very smart about how you position yourself, how you use your capital, who you hire, and what markets you go after. And again, just really focus on your operating metrics to get through it. Because if you wind up on the other side, you're going to do very well.
I agree with Rebecca that it's always a great time to start a company. There's no bad time to start a company. So if you're focused on building a great company, you should be ignoring all of us. You should be ignoring what's going on in the financing market, because if you're trying to build a company based on timing the financing market, you're screwed anyway. Just build a great freaking company. Focus on the fundamentals, which is hopefully what you're doing anyway, and the rest is noise. Just, I think there's way too much talk about the financing market and unicorns and a bunch of nonsense that distracts entrepreneurs. The only thing you need to do is build a great business, and that's the important word, is business. Not just a great company, but a great business. And if you're doing that, then you're going to survive any financing market, any downturns or upturns, because there's always capital available for great companies.
Great advice. Build a great business, don't worry about the unicorn status. But what seems different now, to the panel that I wanted to ask, what seems different now is the amount of a seed stage investing going on. It's a lot different than 2001 and 2008. There's tons of incubators and accelerators. We have syndicates. I don't have figures in my head, but the seed stage investing is off the chart. So, will there be a retraction? Will Techstars and others, pull back? No. Micah says no. Go ahead, Andre.
Is it on? Is it on?
It is on.
I think you do see a lot of traditional AV shops kind of going down to try to do a little bit of unicorn hunting. And I think that if there is a retraction, they're the ones who will retract just a little bit because there's maybe less unicorn hunting. But there's still a ton of money in seed funding. A lot of funds raised new funds over the last 18 to 24 months. That cash is still there. There's still a lot of angel money. There's still great public company outcomes. So there's a lot of money around there too. Like I was saying before, I actually think that it'll turbocharge seed investing, like professional seed investors even more. And then maybe some of the $1 billion funds that are unicorn hunting may become more choosy, pull back a little bit more.
I think it happens. I think it depends on the public markets largely. So what we saw in 08, and I had just entered into venture in 08, what we saw in 08 was there were a few weeks where there were probably no less than 6 or 7 companies that got their term sheets pulled from angel investors. And these were very different than the profile now. And it's because the public markets took a big dive and the angel investor was sort of a high net worth individual. So I think it depends what happens in the public markets. I mean, we're sitting at a time when the price to earnings ratio is one of the highest in history. I think there was just a Goldman report that came out that only 6 times has it ever been higher. And so I think in that, and that's what we've always cited too, that the public market's still fairly rational, where it's becoming not. And so, it depends, which category of angels you're talking about. Institutional may be different, but I think in the personal angel fund, it depends. If there's a large correction in the public market, you'll see that probably react very similarly to 08. And then even in the institutional market, what those funds are balancing is they have a portfolio allocation. If the public markets are high, they can have the percentage of private and venture can be higher. The public market gets compressed, they have to pull back on their venture allocation. So I think largely it depends what we're going to see in the public market and if there's a correction there, because that will ripple through. It'll take some time to do so.
So you asked about seed rounds, right? And
Yes.
Yeah. So I actually don't think we're going to see much of a downturn in seed rounds. Maybe later downstream. I know that's a little contrary, but there's so much money around, and we see thousands. In our programs get thousands of applications. We only take 10 companies per program, so it's not a huge number actually. So maybe our applications will go down, and some people will go into finance and do other things when they leave business school than starting companies. But I think we're going to be, funding the same amount of companies, and they're going to be finding seed rounds.
As much as it's been really easy to start a company in the last few years, it's been just as easy to become an institutional investor. Right? It's never been easier to become a VC, and I think in the coming years, it's never going to be harder to stay one. So, from our point of view, as long as institutional LPs are chasing yield, there's going to continue to be opportunities for seed funds and seed companies to raise capital. And the reality is there's no yield anywhere else, and the market, if anything, is going to turn down. So we don't expect that to change, but we do think the proof points, both for startups and for funds, are going to have to be material in the next 3 to 5 years.
I mean, we actually raised money in 2008, my last company, 2008, and then December 22nd, 2009.
Wow.
So couldn't have done it more difficult route. The truth of the matter is that for companies raising, if you get enough cash going and you're really focused on that show don't tell, the downturns and adjustments in the market actually don't matter to you.
No.
Right? Like, you're not actually being affected by what's going on because you have your bank account, you have the things you're focused on. You just can't hire 15 people. You have to hire 8. And the other thing that I think is really important is sort of the rich get richer, in the concept of, if there is a downturn and there's less investment, most people are going to be looking for name brand funds, assuming that they have the most money, and they're going to miss out on all these great sort of investors that are sort of the second tier in terms of name recognition. And those guys, I think, can actually really take advantage in a downturn, because they're going to get access to deals they couldn't get before. They're going to see things that other people don't see, because people are going to be looking to fill rounds, or they're going to need a lead that isn't getting the same level of inbound that Andreessen's getting, or a Homebrew is getting.
Well, and the other thing that happens in a downturn, to your point, is a lot of these sort of maybe name brands, or let's just say people that have 10 plus boards, right? So you're looking at a partner in a venture firm that has a lot of boards. Well, they're issue number one in the downturn, and we saw this firsthand in 08, was even though they have money, they're not deploying it because they're focused on trying to help their 10 companies survive the downturn, right? And the time a new company gets is very little. So I was fortunate enough to come in 08 without a board, and we did Lending Club, Evernote, and Practice Fusion all in that year. And could spend a ton of time with them and really help them out. And so I think that it's just, again, to the point of it's not the firm, it's the investor, I think, that you get at the firm is really important. And an investor, too, that's been through a few of these cycles and stuck by the companies as they've gone through and really helped them and been in the boat with them. That's very important.
Well, I made a joke about the tombstone, the RIP Good Times, but that was the message from that. It was focused on the fundamentals and just do good business.
It was the get your shit together like message is what that was.
Right. Focus on your
it was pretty crazy.
Yeah, get your shit together. We dropped unicorns, now we're casting whistles.
Sorry, don't worry.
No, it's okay. So for the entire panel, what are you seeing in terms of deal terms? There's been a lot of talk lately about unicorns and the prices are coming down. Are things becoming more affordable, or is that just a mirage? What is the panel seeing?
What stage are we talking?
Yeah, early or late.
For the sake of this discussion, let's focus on early.
So I, for the first time in a number of years, got offered or like a couple of down rounds in the last few weeks. And it was interesting. They were interesting companies. They just kind of hadn't found their way. And the mistake and I didn't do either deal for other reasons, but I was shocked because that just was a wake-up call to me. And in both of those companies, they were situations where in a prior round, the CEO had gone for valuation over investment in terms. And so now I talked to the company, I was interested, but the expectation of valuation was quite high for the next round, and so we decided not to go forward. And then about 3 or 4 weeks later, I got a phone call saying, hey, we might adjust that expectation. So I hadn't seen that in a while, and that was, I think we're just starting to see a few of those.
What stage was that?
Stages. That was Series A and B.
Right. So I think in seed, we haven't seen it yet.
Yeah, I haven't trickled through yet.
Yeah.
Yeah, I think, go ahead.
Go ahead.
Seed's still very bullish. We put out a report today, even sizes for convertible note rounds and safe rounds, where if you were raising $2 million, it was going to be a price round. That's changed. It's definitely a possibility to be able to raise a note round or a safe round. The liquidation preference overhang issue that Mark Suster blogged about maybe 2 months ago, that's come into almost every convertible note deal, basically protecting the company from too much liquidation preference when there's a huge note discount. Investors being more and more willing, even in seed price rounds, not to take board seats. So it's still really frothy. Up in the A, B, and later, we're seeing more senior preferences in A rounds when there was a C round before, and in B and C, we're actually seeing these senior liquidation preferences, which is a little bit odd, but I guess it's sort of to protect against the higher valuation. I'm not sure if you're seeing that.
We haven't done that. We believe in completely clean terms to keep everyone's incentives aligned, because whatever terms you have in the A, this is something for entrepreneurs to keep in mind too, whatever terms you have in the A and the B, the C is going to ask for the same, if not worse, right? And so you have to really be cognizant of the precedent you're setting whenever you have terms like that. But we aren't seeing a bunch of, we're seeing at the later stage, right? As you go into the growth rounds, a lot of these big valuations, you ask yourself at what cost, right? And those late stage guys, they're smart cookies, right? They're not just giving a crazy valuation. They're usually getting a crazy valuation with a firm assurance they're getting 2x their money back, right? So those are usually done with or there's an IPO ratchet, or there's some issue that's in those terms that maybe looked okay at the time, but are very much protecting their downside. So we do see that still, and a lot of the companies that have gone public, as of late, had that. I think that's one very smart thing that the Lending Club CEO did, is everything was always clean. He never focused on the highest price. He was always the best investor, and I think that was incredibly wise to watch him go through that process.
So there's still money to be had. I can see that we're winding down. Excuse me. what final advice would the panel have for the entrepreneurs in the audience who are raising a fund, or who are raising a round, or considering that the music is going to stop? What should they do? You already kind of said it a little bit. Focus on the fundamentals. Any other advice?
Raise now and raise as much as you can.
Raise as much as you can. Is that wise advice right now?
I mean, I think as a founder, you only have two jobs when it comes to fundraising.
What's that?
One is make sure you have money in the bank, and two is maintain optionality, right? So anytime,
Optionality, yeah,
yep,
maintain
optionality
options.
meaning thinking about where you want to set the valuation bar, how much capital you want to raise, and what it means in terms of what you need to accomplish to raise the next round of financing. But your number one job is to get money in the bank. So, if it comes down to taking more dilution that you want to take, settling for an investor that you're not as excited about as you might be otherwise, like the reality is in a market where it's getting harder and harder to raise money, your number one job is to survive. So I think, raise money and get back to work. Those are the only things that are going to matter in the next little while.
Yeah, I guess the advice I'd give is that rounds are taking longer to close.
Yes.
So factor that into your planning, right? Like, things don't close in 2 weeks anymore. They're taking months, if not, longer. So be patient. Second of all, as you raise each round, think about where you're putting yourself for that next round, the concept of optionality. So if you overcapitalize, overvalue yourself early on, that next round may be tough. If you are, if it is a bad downturn and all of a sudden we're in a deep downturn and all of a sudden you're trying to go out there with, $30, $40 million valuation for a company that's probably worth, 10 or 15, you may actually have done better for yourself by lowering that valuation up front. So think through long term as you're raising rather than just trying to get as much money in the bank as you possibly can, as quickly as possible.
Have guts and realize it is a unique time, that there is an opportunity, and sort of look for those opportunities. Either if you're an investor, if you're an entrepreneur, I always point to hiring. There will be some opportunities to find great talent. Stick it out. That the best companies are built during these times.
Yeah.
Go ahead.
Sorry, Alastair. I think it's don't overthink it. I think, especially with a lot of the incubators and stuff, I see entrepreneurs, and it's like their sort of focus is more about raising money and from who and putting the names up on the board, and that it shouldn't be that way. I mean, your focus is building a company, and if any of you have ever heard of Travis Kalanick's story at Red Swoosh, it's pretty phenomenal, right? I mean, the guy couldn't get anyone to back him. He moved his whole company offshore, and he owned most of it when it sold. And that is an amazing entrepreneur, as we've now seen also with Uber. So, your goal and your purpose is to build a company. Raising money is a means to the end, but it is not the end. And what's so frustrating for us right now is I feel like a lot of people see it as the end. And I can't tell you how many entrepreneurs I talk to that I'm like, wow, you've got a really interesting business. It's going to throw off this much cash. Why are you taking venture money? Just run this business, right? So really think about that. There are other options. Venture is not the end. It's a means to an end. And you better really think about whether that makes sense, because as soon as you step on the venture path, there's a certain track you need to be on. And it's not right for every company. And there's so many amazing and interesting companies out there that are privately held that didn't go the venture route. So I'm not trying to sort of disparage my profession. I just, it's a great time to start a company, and just think about what path you're on, would be my advice.
So
Okay.
I would just add one
Final
point.
thought, Jenny, go
Yeah, I would just say develop those relationships with your next potential round of funding early, right? So that's why I've been telling my portfolio companies, you just need to start meeting those people. Even if you have 18 months of runway, start developing those relationships. It's pretty unlikely that you're gonna, walk into Google Ventures on the first meeting and, they're gonna fund you, right? So you need to have those relationships. They need to see the traction, the proof points, and they basically need to get to know you and like you, so.
Well, great. Well, I'm glad we got all the mics to work. So to sum up, things are bad, but they're not that bad. There's still money to be had from investors. There's still ideas out there that you can hire people, and things are going to turn out okay if you focus on the fundamentals and not worry about becoming a unicorn. Well, with that, our time is up. So thank you very much, and thank you again, panel.